Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me as part of our virtual Financial Markets Quality Conference at Georgetown University is Jim Angel, Associate Professor of Finance at Georgetown's McDonough School of Business, to discuss crypto, the impact a new administration could have on U.S. financial regulation, and the rise of retail participation. Jim, it's great to see you again. Welcome back to Trade Talks. And I haven't seen you in a year, so now we have a lot to unpack, especially 2020 has been such an interesting year. And many traditional financial service firms are entering the crypto space. What does that mean for investors?
Well, first of all, be careful. It is the Wild West in crypto. And just like there were plenty of opportunities to look for gold, there are also plenty of opportunities to die in the desert as well. There are many different opportunities out there, but just because you can buy a crypto product doesn't mean it's in your best interest. And indeed, just because you can buy rat poison in the supermarket doesn't mean you should. But if you have some rats to kill, it might be rather useful. And so the important thing is to be very, very careful and understand what you're buying, what kind of backing it has, what is it that gives it value, and what is it that makes it part of your investment portfolio. There are many, many, many different crypto products out there, many, many different coins, and many of them are going to wind up worthless. Which ones will actually have value and be good investments? I don't know. But so my recommendation is be very careful.
And what impact will a new administration have on U.S. financial regulations once we finally get this transition through?
Unfortunately, I think it'll be basically more of the same. We still have the same regulatory structure in place. We still have a lot of the same people working in the regulatory agencies. So I think what we'll see is not so much a major shift, but more of a slight tilt. A little bit away from the deregulatory pushes from the Trump appointees, a little bit more pro-consumer. But unfortunately, we still have a very dysfunctional structure that is the result of Congress. Having separate agencies to do commodities versus securities versus other stuff really doesn't make any sense. No other countries really do it that way. And we need to fix it, but I don't think this Congress will do it.
What's interesting for 2020, we've seen a rise in retail participation in the market. What do you think the eventual impact will be?
Well, I think this is fantastic. We have a new generation of investors who are actually trading, which is a good thing. Because what they do is they bring information to the market, they bring liquidity, they bring risk-bearing capacity. This is good, not just for the investors, but also for the economy, because their willingness to look at individual securities means that they're willing to buy companies. And one of the problems we've had in the US is that, as you well know, over the last couple of decades, we've had fewer and fewer public companies, mainly because investors have been ignoring those smaller growing companies. And now that we have a new generation of investors who are coming in and actually looking at individual stocks, I think this is going to be good for the economy as well as good for the investors.
And Jim, it's also good for the investors in another aspect, and you and I spoke about this in STA in 2019, all the tools that are at their disposal, the platforms that are available, which weren't even available to us as professionals in the late 90s and early 2000s. So that's another advantage for retail investors.
Oh, this is the best of all possible times in the retail world. I mean, commissions have evaporated. We have information now that you couldn't buy 20 years ago. So really, I'm really envious of the young generation. They can just go tap, tap, tap on their phone and do the kind of trading that I couldn't have imagined many years ago.
And some people say that these new investors are just gambling. Is that a problem?
No, I don't think that's a bug. I think that's a feature. One of the many benefits our financial markets provide for our society is entertainment. When people play the market, guess what they're doing? They're bringing in capital, and more importantly, they're bringing in information. They're going out there trying to figure out what are these securities worth, and that information makes the markets function better. So, for people who want that type of entertainment or that kind of action, it is far more socially beneficial for them to do it in the market than it is for them to do it in a casino.
That's a very good point. Now, with brokers offering fractional shares, should high-priced companies split their stocks?
Yes. Companies that have this Warren Buffett wannabe envy to have the highest price stock are not doing their shareholders any favor, because When the stock price is too high, there are a lot of operational frictions in trading the shares. So the brokerage industry is working around it with fractional shares, but those are still messy to trade. So the companies with very high share prices will be doing their shareholders a big favor if they split the stock. If you look at what happened to Apple and Tesla after their stock splits, that tells you that it's actually a good thing for the shareholders for you to actually care about the shareholders and split your stock when the stock goes too high.
All right, Jim, great to catch up with you as always. Thanks for joining us on Trade Talks.
As always, Jill, thank you for having me.
You got it. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.